2008 crisis.
We are going live in next 5 seconds.
Deepak Harsh is yet to join.
Yeah, he is joining. So he just messaged me that he will be joining.
Sure.
So dear participants, once again, welcome to you all to this the special plenary session on financing infrastructure, building India, role of Indian financial markets. We have a very eminent panel with us, and we are also privileged and honored to have Shri Sujay Bose as an to address this particular session. Mr. Sujay Bose is a business leader with over 3 decades of extensive experience in emerging markets, investing and project finance, covering infrastructure, industrials and services sector. During his career, he has worked on projects covering over 50 countries across Asia, Africa, Europe, Middle East, Latin America, and the Caribbean. He holds a bachelor's degree in commerce from St. Xavier's College, Kolkata, India, and is an MBA in finance from Rice University, Houston, Texas. Thank you so much for joining us, sir. It's truly an honor and privilege to have you with us today in this summit. And we are also being joined by eminent panelists. The session will be moderated by Mr. N. Sivaraman. He's the Managing Director and Group CEO of ICRA. And Mr. Harsha, Managing Director and CEO, Integrate. Mr. B. Prasanna, he's the Group Head, Global Markets, Sales, Trading and Research, ICICI Bank. And Mr. Mukesh Soni, Executive Director, Kotak Investment Advisors Limited. Thank you all for joining us. And now I request Mr. N. Sivaraman to kindly take forward the session, sir. Thank you so much.
Thanks, Deepak. I think one of the key drivers or the impetus that will be there for the economy, given the rest of the environmental constraint that we have, is going to be the level of investment that will funnel into the infrastructure sector. We have talked about the national infrastructure pipeline, targeting about 111 lakh crore of investment. While the last year, to some extent, the investment were constrained by the environmental constraints as well as the fiscal constraints arising from commitment to various social initiatives. I would guess that it's going to be time that the government looks at it carefully, as well as make sure that there are sufficient enablers on board. While the government is itself is spending quite adequately on the infrastructure sector, one cannot fault them even in this at this level. But clearly there are going to be a lot more enablers, and the panel's effort will be to extract some of those ideas to be able to find ways of going forward in the sector clearly. We have the new financial institutions being promoted. NIF itself has got its own IDF as well as the NBFC platform to support infrastructure sector. Will hopefully provide the right level of capital availability to the projects, right? The amount of capital commitment is very significant in each one of these areas. I'm sure that there will be sufficient scope for capital raise within the market, both from Indian domestic markets as well as the international markets. These are such credible institutions which should enable capital flow much faster than what we have seen in the past. The other aspect is also the bond market, whose development is equally important for some of the mature projects to access the money from a diversified source of capital, while the construction period of financing can come from institutions. But this is also an area that we need to really look at. So with that, I will request Sujoy to make his opening remarks before we move on to the panel discussions.
Thank you, Sivaraman, and very good afternoon to all my friends and colleagues who have joined from the industry and beyond. I would, of course, like to first of all thank CII, National Committee of Finance, and Mr. Nilesh Shah for giving me this opportunity to talk on a topic that's actually very dear to my heart. So after a tough March and April, the Indian economy is back on track, and there is increasing hope that the worst is behind us. I just came back from the US, and the view there is very similar, as is the case with several other nations. In fact, in India and the US, the debate is starting to shift from economic recovery to the interest rate cycle as prices of inputs as well as the demand supply equation for labor start to fuel some inflationary concerns. And particularly, I think everybody is watching the US Federal Reserve, whose actions have implications for the rest of the world, including emerging markets. In India, from an economic perspective, the indicators look strong. I don't want to repeat the high frequency indicators that all of you follow carefully. I just want to point out that from an infrastructure investor's perspective, it is great to note that in August of this year, rail cargo volume, container volume, bitumen demand, petrol demand, electricity demand, FASTag receipts all exceeded FY20 numbers, FY20 numbers, the year before the pandemic. And all these numbers were well ahead of any expectations that any of us, I think, had. S&P expects India to clock an economic growth of 9.5% in the current fiscal and 7% in the next fiscal. This is robust. Within the context of this economic recovery in India and around the world, an important trend that infrastructure investors can look forward to is that governments in several large countries are planning to lead spending through infrastructure development. As we know, it's one of the pillars of the Biden administration, and of course, we'll talk much more about India. This is an extremely welcome initiative, and together with the movement towards a climate-friendly and green global economy, which will take a lot of investment, and also the ongoing digital and technology revolution, this infrastructure development focus would enable an investment and job creation cycle which the world has not seen for many years. Many of us actually in the business have been talking about the need for governments to lead with infrastructure development, and in some cases like the US, actually reinvestment in infrastructure, which they have not done for many years. The Indian government has put infrastructure development at the heart of its economic development program well before the pandemic. And it has done so with two clear objectives. First, to improve the competitiveness of the country. To make Indian manufacturing competitive, the cost of logistics and the cost of energy must be lower. Investment in roads, railways, airports, and other modes of transportation, combined with the Gati Shakti vision that the Honorable PM laid out for us on the 15th of August, will help reduce the cost of logistics. I think this whole concept of Gati Shakti, where you bring everything into a strategic plan and sort of master plan around investment, is crucial in achieving this. In this context, I'm actually really pleased to mention that Hindustan Infraloc, a joint venture between DP World of Dubai and NIIF, has created a nationwide rail-based logistics network to improve the ease and cost efficiency of container movement in India. On the energy side, the government's push towards renewable energy for power and mobility will help reduce the cost of power, improve the trade balance, and ensure a cleaner climate thanks to less dependence on fossil fuels. In this context, Ayana Renewable Power, a JV between CDC of the UK, Green Growth Equity Fund, and NIIF, recently won a 450 megawatt wind solar hybrid SECI tender at a highly competitive tariff. Ayana, in fact, has become one of the fastest growing renewable companies in India. The second purpose of infrastructure development in India is to ease the quality of life of our citizens. 24/7 power, easy access to water, use of gas as cooking fuel instead of wood or coal, access to good quality healthcare, cost-effective airport and air connectivity are all aspects of a modern India. That is the vision of the Honorable Prime Minister and his government. In this context, companies such as IntelliSmart, a joint venture between ESL and NIIF, which is supporting the conversion of conventional electricity meters to smart meters, will play an important role in ensuring that customers are able to use the latest technology to ensure ease and transparency of payment for the use of infrastructure facilities. FASTag, by the way, is another great example. Of course, this is good news for the capital markets in general, but how can the market specifically participate in the Indian infrastructure opportunity and benefit from it through appropriate risk-adjusted returns? I think that's really the question that I'd like to focus on, and I'm actually very much looking forward to what the panel will have to say on that. I believe that this cycle of infrastructure development will lead to a massive funding opportunity for the capital markets in India. And over the next few years, Indian infrastructure assets will gain in share of the portfolios of both equity and fixed income investors in the country. Many of our investors, NIF mostly works with international investors, and many of them have in the past said that the supply of capital for Indian infrastructure assets is greater than its absorptive capacity in terms of investable opportunities. In my opinion, this is about to change. The government's infrastructure plans are summarized in the National Infrastructure Pipeline, which is a comprehensive list of all the major infrastructure projects planned for the next few years. Total investment target under the NIP is 111 lakh crores. While the NIP itself may not be fully suitable for capital markets investors, because and the capital markets usually focus on post-construction cash yielding infrastructure, the government proposes to finance part of the NIP through asset monetization. The national monetization pipeline is estimated by the government at about 6 lakh crores, a substantial number. Add to this a fairly large pool of private to private sales of constructed infrastructure assets, and this is what provides a major investment opportunity for the Indian capital markets and for Indian institutions that mobilize domestic savings. Infrastructure assets, which are often regulated monopolies or benefit from long-term offtake contracts, provide investors with a predictable cash flow and are an ideal match for long-term investors and long-term savings. They also provide diversification for more volatile equity and bonds for institutional investors. Hence, around the world, infrastructure assets have become a favorite for institutional investors, and the same, in my opinion, is starting to happen in India. I had so many friends who are not really infrastructure experts who were attracted by the PGCIL InvIT issuance as they realized it was an opportunity to earn a decent return without taking on any kind of outsized risk. Many more such opportunities will be available in the capital markets. Challenges remain in the sector. Government, I believe, is working on them with a laser focus, and some of these challenges include off-taker risk in a federal democracy such as India will need to be managed. Central government offtake mechanisms such as SECI, NTPC, and the renewable sector addresses some of these issues to some extent, and more will need to be done along these lines in, say, the urban infrastructure sectors, where the municipalities and the cities are not often fully either do not have the development expertise or the financial strength to develop and sustain major infrastructure projects. Long-term concessions come with the need for independent regulators and strong contract enforcement frameworks, since there will always be unforeseen situations to be dealt with along the long-term concession periods, and those situations will need to be fairly assessed for both parties. Finally, the movement of interest rates must also be considered in assessing this asset class. Despite these challenges, I am confident that we are entering an era where the interaction between the Indian capital markets and Indian infrastructure will continue to gain strength. The various infrastructure monetization models used by the government, such as TOT and HAM for roads, InvITs for various government agency managed assets, PPPs such as in the airport sector, and many other forms of monetization. And I should not forget the private opportunities that are also available, such as IndiGrid and others, will provide significant opportunity for institutional investors such as pension funds, insurance companies, AIFs, mutual funds, developers, operators, and others on the equity side. The opportunity for the bond markets is even larger. While construction of infrastructure assets are mostly financed by banks, and of course, the new development finance institution, NABFID, will play a significant role there. Bond markets will find financing of operating infrastructure assets quite rewarding. In fact, S&P had done for many years, and Moody's have been doing these studies where it shows that both in developed markets as well as emerging markets, while there is a significant difference in the risk pre-construction, post-construction, the risk is actually not that different. And that basically says that even in emerging markets, post-construction infrastructure can be a very rewarding asset class for bond investors. In this context, NIIF now has two fully operational infrastructure financing NBFCs, NIIF IFL and Asim Infrastructure Finance, which has been issuing bonds in the capital markets for some time. And I hope some of you will participate in some of those issuances going forward. With that, I just wanted to make some of those high-level comments, but I really look forward to the rest of the session and to hearing from my esteemed co-panelists on their views. And we at NIIF look forward to working with all of you on a sector that is of great importance to all of us and to the country. Thank you very much for this opportunity. And Sivaraman, back to you. Thank you.
Thanks, Sujay, for that. I think as a capital market participant or as somebody either as an issuer or as a rater or as an intermediary, we are all excited about the size and volume that you mentioned. I'm going to draw you into some of the questions to get your insights as well. I hope that's fine in addition to the panelists. That it'll be good to have your views as well. One of the things that are foundational for any kind of credit development of the sector is going to be either from the debt perspective or from an equity investor point of view, the development of the regulations, how well the regulations have evolved over a period of time. I remember from the first time when L&T entered into a MOU kind of arrangement for certain sector as a, we call it guinea pig or the pilots. L&T had done some of those projects and success and also pains around that because the regulatory environment was not strong. But today we have come a long, long way from there. I think as Harsh, who is one of the sponsors or the part of the sponsor group, he can talk to us about it. And I would definitely like Sujay's views also as to where of the regulations have evolved and where do you see specific sectors that need to be covered on even in the mature sectors, where will they be? I'll definitely like Harsh and Sujay to cover. And perhaps Mukesh with his experience in investing in the projects can also come in to contribute to that. Harsh, you want to go first?
Sure. Thank you. Thanks, Mr. Sivaraman, and thanks, Sujay. So I think we are a unique animal which is between two regulatory bodies, whether it's a power sector as well as I would say multiple other regulatory bodies involved in InvIT formation over the last 4 years. I'll touch base on both of these. I think on power sector regulation side, last 5 to 7 years has been fairly revolutionary, I would say. Partly because of the technological innovation that is happening in the country and around the world, where the cost of electricity is coming down drastically from a clean tech sources. And we see storage where solar was 10 years ago. And a mix of these two is have a potential that a country like India can tremendously electrify the whole energy consumption. And when I say energy consumption, it eats into oil and gas as well. So it has a potential of a substantial expansion of the sector. Keeping that in mind, the regulators have been acting very, very actively with respect to forming new regulation, whether it's a prototype of a storage power plant or a combining storage and generation bid to different regulations on including delicensing of distributions. I think there are fundamental revolutionary steps that are being taken. But the sector's momentum will only change in next 5 to 7 years. But I think we see it as an exciting sector over the next 5 to 10 years, where technology will have a huge play, regulations will have a huge play, and that regulators are keeping pace with what's happening around the world. We should not lose the momentum is the only message that one can think of within the regulatory space, and not the irritants of federal structure, as Sujay mentioned, of different state bodies renege on the PPAs, because that changes the fundamental tenet. But besides that, the regulator is doing a superb job in keeping up with the progress of the sector. On the InvIT side, it was, I would say last 3 years were very difficult because the coordination between RBI, insurance, SEBI, all the regulators took some time to streamline the regulations. While there can be still some wrinkles to iron out, but in 3 years' time, I would say this is one of the biggest success of Government of India, Ministry of Finance, and all regulators, that you can have a new financial platform become a 2 lakh crore platform in 3 to 4 years, right? So with different asset classes within the framework and different kind of sponsors and investors. So I think phenomenal support and speed by all regulators that we have seen.
I do agree. I think even the appellate bodies are supporting contract enforcement very actively. It takes time to get all the orders passed through various levels, but at the end of the day, the central government support on honoring the contracts as well as the appellate process, which is forcing it. Before I come to Sujay, maybe views from Mukesh on the regulatory evolution.
Yeah, so thanks, Shiva, for having me over here. So, we are talking about infrastructure. So, whenever you speak on infrastructure, there is a regulatory body on the other side of it for sure, because that's the nature of infrastructure across the globe. And what we have seen, apart from what Harsh has spoken on the power side, road sector is something that I want to highlight over here. That NHAI, being the regulator, has been one of the most phenomenal regulator that has transformed the road sector in India, attracted a lot of investments, and they have eased the whole process where the ambiguity is not there. When people are very comfortable to either lend or invest in that sector. What we have seen in like the earlier concession agreements, whatever anomalies were there, the current regime has taken them out. They have given the new things like HAM projects where there is a support to the private investors and also to the bank that comfort from NHAI comes in. Land acquisition process has been made very, very clean. So you see that the technology is also coming in. The FASTag has made, as Sujay was pointed out, that the collections are back to the pre-COVID level. So of course, FASTag has made a very significant contribution over there as well. GST going out has eased the movement of traffic. So road sector as a regulator and investors over there has done phenomenally well. Things are getting better in that sector. Another sector I want to point out is the airports. So of course, India has a very less number of airports, but again, government has done their bit by announcing greenfield projects on the airport side and taking the tier 2 cities airport and modernizing them. So of course, this might be part of the overall monetization of their assets, but this is what India needs. This is what the taxpayers are looking at, and government is doing their bit for sure. Coming to railways, go back 10 years from here, the concession agreements of railway land to be used was very one-sided. People were scared. The investor will never touch it. But again, government has eased out. The concession agreements are getting redrafted. People are listening in the government corridors that what the investor thinks about it. So I think these will also evolve. And as our panelists have spoken on the NIP, so NIP started well. However, COVID hit it. So I think that year 2020, 2025 period will get readjusted somewhat, that how we will look into the investment side of it, because around 80% of the money comes from the government. As for the sources that has been defined, only 20% will come from the private investors. So government has to do more what they are doing as of now. And we will see more sectors on the subsectors on the infrastructure side will do better, with regulator listening to us, regulator redefining what is good for both the lenders as well as the equity investors.
Right, thanks, Harsh. I think wherever there have been significant number of solid examples, the regulatory evolution has been pretty good. Roads, transmission lines, or the power sector, power generation sector, clearly. We still have the distribution sector regulations may not be up to the mark, or water could be another area where there is still gap could be there. The ports, somewhere there, I think somewhere maybe there. Maybe can we hear Sujay, because his interest is across so many sectors. Maybe his views on where we need to really move forward on this will be very interesting to hear.
Thanks, Shivam. So I want to reiterate to some degree what Harsh and Mukesh have been saying, and I think the most I would say what makes me optimistic about the regulations, because the regulations will continue to evolve. India is still not at the point where we are, the regulations are perfect. In fact, what I like to say is if the regulations were perfect, then infrastructure investors would not be making the returns in India that they are making. Then they would be making the returns, that they are making in OECD countries, which is not why people invest in a growth economy like India, right? So the two go hand in hand. But what makes me optimistic is exactly what they said, which is that the regulators are actually listening. The regulators and the government is listening to investors. And I think the InvIT regulations is a fantastic example where, through listening to investors, those regulations have actually been rapidly evolved to a point now where it's a very attractive asset class for many investors. When I look across countries, India actually does pretty well in terms of ranking. I mean, even if you look at some of the international ranking in terms of regulations for infrastructure, for the infrastructure sector, India actually does pretty well. The issue is as follows. I think where I feel that there has to be more focus. First is, the regulations are changing. And I think we have to deal with that, because that's, of course, for infrastructure investors, predictability and stability is a key part of our DNA. And changing regulations always is unsettling, but that's part of life. And as I said, it has a connection with the return as well. Second is, I think the independence of the regulator is a crucial factor. And I think the more we move towards independent regulators, I think both parties will benefit. And I think the final aspect that I kind of mentioned in my speech, which is in a long-term concession, a lot of stuff will happen that was not contemplated when the concession was actually granted. And I think the key thing becomes, what do you deal with those outlying situations? How do you deal with those outlying situations? And that is where I think often our bureaucracy and our regulators get stuck because of the risk of, or because of the challenges of taking risk in a system, right? And that is where I think the independence of regulations, contract enforcement through the court system, etc., it's good. I think in many cases, when something like that happens, I think it's good for both parties to go to court and get a settlement, right? One way or the other, get a view one way or the other. But it doesn't really work that well as yet. But I think it's progressing. I think, what we have seen over the last 3-4 years is that a lot of some of this stuff is also getting sorted out through the empowered, sort of panels of secretaries and so on and so forth, which are, tools that I think the government is using to settle some of these situations. So it's great. I mean, when I weigh the risks with the returns in the sector, I think we are at a good point, and that is why we see all this interest of international capital looking for infrastructure assets in the country.
Really, what I hear from Mr. Joy is that the government is willing to listen and be flexible about evolution, because they do appreciate the need to get the capital required to be able to support this 111 lakh infrastructure, 111 lakh crore infrastructure development. But having said that, I think there are not enough solid examples in many of the other sectors. You take either power or the transmission line or even the roads. Most of the regulatory evolution was driven by private sector experience. Okay? Some of them, to some extent, it has actually driven out the sponsors out of the zone, and we find more and more funds investing as a sponsor in lots of the project areas, clearly. So some of these gray or other infrequent privatization of the infrastructure side, like water or in the case of ports, do you think government should take the first step, make the investment, create the structure, and then move towards like the TOT option of optioning it out to be able to help the very orderly regulatory evolution rather than the kind of shocks that we saw in some of these areas in the past? Either Harsh or Sujay can respond on that.
I would just add 2 bits on that. I think this is a fundamental point for any developing economy. It's important that government takes certain development risk which investors per se may not be able to fund it. And historically, if you look at India, 90% of infrastructure is built by the government, right? And it's the largest infrastructure asset owner.
Absolutely, absolutely.
But it would put fiscal burden on the country. And till now, asset monetization was a bad word, right? And every government would think twice, or if at all they can think that we can look at monetizing assets without attracting a political turmoil. So this is the most important step, is that with this strategic way of making the NIP, it makes it clear that, look, asset monetization is part of the bigger plan, which will fund the development capex that government can do in, let's say, less evolved sectors, like you mentioned, water or airport or others. So those are the sectors where government can spend their capital and bandwidth to develop those sectors ahead, which are relatively behind in evolution, from the capital that the government gains from monetizing on the much more evolved sectors where investors would feel comfortable deploying capital. So we are on the right track, but certainly the success will depend on whether government executes the entire pipeline efficiently, creates fiscal headroom, and then invest in the further underdeveloped sectors. But I think it's in the right direction, and this is the best way this can be done for any government or any development economy.
Sure. Is there any further thoughts you want to add?
I agree, and I'm a big proponent of this whole concept of asset recycling. And it also makes financial sense. So, as Harsh just said, there are certain risks in project development and project construction that if you give it to the private sector is going to price that risk. I mean, I have a very practical approach to this, right? And when you price that risk, the private sector is going to ask for a 25% IRR for that risk. Why should the government, or why should the citizens of the country allow for that, right? It would in those cases be perhaps better for government to build that project, because they can price that risk at the lowest level, and then actually monetize that project once it has been built, and actually make a super return on that for the country, right? And at the same time, then take that money that comes from the monetization and use that money to continue to develop other projects. So I think there are sectors such as renewables where the private sector is very happy to take the risk, and that risk they're taking at very competitive returns, equity cost, both capital cost as well as debt cost. But by the way, same goes for the banks who are going to finance those projects, right? In many cases, if there was a private company developing the Delhi-Mumbai Expressway, which is probably a $10 billion project, it would be very challenging for the banking sector to support that private developer. On the other hand, you build the project, and then someday, I can assure you, there will be a bunch of pension funds, including hopefully by that time, Indian pension funds and insurance companies, who would be willing to participate in the monetization of the Delhi-Mumbai Expressway. Imagine that road is probably going to be one of the most important roads in the world, connecting two of the most populated cities. But building it, acquiring land, getting approvals, and all that stuff is not, is challenging for the private sector, right? So this whole concept of asset recycling in sectors that are more challenging is something that I think is very useful. And many other countries, Australia, UK, they have actually used this model extremely efficiently.
Absolutely right. I think the route of government making the investment and sell, or rather auctioning it out, could help in a very orderly evolution of the regulations as well, because there will be rather than having the project and running the risks, it will be better that the risks are well covered as part of the bid process itself. So that takes me to the next subject, which is about the capital availability for the sector. 111 lakh crore is a very ambitious number. It's daunting in the context of India, very definitely. The last time, I think UPA also had a plan of about $500 billion of investment as the first 5-year proposition. I don't know how much we got finally to invest over there. But between Prasanna and Mukesh, I will try and see whether we can get some of the answers over here. Maybe I'll request Sujoy to step in as to the development institutions. How will they play the role? Whether it will go the route of some of the earlier DFIs, or will it be different? I'm sure that he can contribute his thoughts on that. So Mukesh and Prasanna, there is only so much capital available in the country to be deployed between deposits, government securities, or public bonds, equity, etc., etc. Based on all the assessment that one has done, the gap in the financing for this 111 lakh crore could be anywhere between 15 to 20%. That's not a small number, very clearly, right? What is it that we need to do on the ground to get this money from international markets, or whether the PFs invest in government securities, or if PFs don't invest in government securities, somebody else will have to invest. So that's the domestic capital only is so much based on the savings that we provide. So very clearly there is a need for a flow to come in. We had a brief discussion before we started this conversation. So I'd like to hear whether the current regulation, the risk environment that's here in the country will enable the kind of capital that we need to really support the development of the infrastructure projects. Equity, I've seen reasonable growth, interest and flows are pretty strong. So that takes us to the debt. Without debt, the project, the equities are not going to get returns. So Mukesh and Prasanna, your views on how do we get there?
So maybe I'll go first. Maybe I'll go first then, yeah. So thanks, Shiva, for having me. And actually, when we were really thinking about this whole, I mean, before I come to the financing part, I just wanted to add by 2 bits on this entire infrastructure boom that we are expecting will happen. And for us, or for me, it almost looked like a sense of deja vu that haven't we not seen it in the early 2000s, where things had gone wrong. Till then, I then was, thinking about it till the time I realized that the government and the regulators are doing this cycle a whole lot different. Not only is the boom there for real and it's going to be a global synchronized infrastructure boom, there is a far more synchronicity, if I may call it, within the various government departments to figure out what exactly is infrastructure, what is needed. Because clearly when the private sector were asked to do it last time around, I don't think it really, it had a lot of accidents, as we all know. And so look at infrastructure, segregation and collection of all the thoughts at one place with the government. And when you look at the fact that one of the tools which is being used is the monetization plan. And like you, Sujay and Harsh have spoken at length about the monetization and the recycling as to how it aids. It kind of fits in perfectly with the making the bond financing or the financing of these things better. What went wrong previously was a fact that there was a difference between the risk appetite which the bond investors had or the capital markets had and the kind of risk which was available in the infrastructure space to lend. And I think that's exactly what has been identified by this government when they announced the monetization pipeline. We will take care of the risk. We will do the building. Once it is done and it becomes operative and the cash flows start coming in, I'm ready to get the investors from him. So I think it's a great idea. And that itself will mean that when you try to do the credit rating of some of these, sir, you know that better, and I'm sure you'll be able to contribute as well. When you do the credit rating of all these brownfield assets, they'll get a far, far better rating, and hence the bankability, so to speak, of all these projects becomes much, much better. On the financing side, more particularly, sir, like you spoke about the bond markets and the debt capital markets and all that. So, I mean, one is obviously looking at foreign investments. But before we even get into the foreign investment, there is a whole amount of money which is actually available within the domestic space as well. Like all of us have spoken about how the regulators have called it right in the last 3 years. We may quibble about it, but there are a few small steps that might be required even to attract more funds from the domestic investors here and there, which when done will possibly make it much more bankable even from the domestic perspective. So you have insurance companies, the provident funds and the pension funds with their long-term funding. You have mutual funds who more or less in the short-term funding right now. And then you have the banks who are earlier had taken the risk, fell into accidents, but now would be willing to take the risk with brownfield risk. So I think brownfield projects. So I think the usefulness of the bond platforms for all these REITs and InvITs and the infrastructure financing guys is possibly going to be much, much better this time around with the credit rating taken care of, with the greenfield risk kind of taken care of, and also the ability of the bond market to kind of, do a lot of structures. You can do long-term fixed rate financing, back-ended bullet repayments. You can do even amortized staggered redemption in bonds. You can do a lot of other product innovation and structuring possible as much for issuers and investors, put and call options. There are endless kind of, structuring possibilities. So all that is there. And then on the regulation side, you need to get, the ability of the provident funds to buy a little bit based on rating, lower rated papers as well, maybe AA minus kind of papers. And those kind of demand side regulations, if it is coordinated between the regulators, between insurance companies, provident funds, and pension funds, I think we will be able to attract more money from the domestic market itself. Coming to the foreign funds, I'm sure Mukesh will add his bit as well. But I think we are seeing a phenomenal change in the way the world looks at India right now. We are actually just about to, people are going to look at the taper in a month from now. But this time around, the market seems to be much, much better prepared. And a lot of foreign investors are looking at, investing in India. For various reasons, it has not really attracted the kind of money in the last 1 year. But I don't think it has anything to do with the kind of environment, the macro environment which was there. I think the kind of regulations, how the risk has been, parceled between the brownfield and the greenfield, and the way the government is doing it. This time around, I'm very, very confident that we will be able to attract much, much more money from foreign investors this time around.
Understood. So to be able to get more out of the existing domestic market, maybe we'll have to release investment in gold and land, right? Otherwise, most of the money is deployed. So we will have to think about how to move people away from gold and land, as well as how to monetize the temple gold also. It's a large amount that's sitting in most of that.
Yeah.
All right, Mukesh, any thoughts from you on that?
Yeah. So thanks, Prasanna and Shiva. So what I understand is that for infrastructure, we would need like long-term debt. Of course, that was not available in India at any point in time. But if you see globally, people have been financing these infrastructure assets for like 15, 20-year kind of tenor. Globally, around $300 billion of only private credit has been raised. We need to see how much that flows into India this time around. And as Prasanna pointed out, that we are seeing political stability, we are seeing the intent of the government by showcasing that, okay, we are changing the regulations, we are making them easy, and government is willing to take the initial development risk, and that's where it becomes easier for people to look at India and Indian infrastructure for sure. However, you need to understand that the foreign investors are scared about 2-3 things in India. First is the legal enforcement. A lender is as good as whether he can enforce the security or not. So that has to be eased out. That has to be seen, that a foreign investor versus an Indian bank who was at Sarfezi, who was at the CDR, SDR kind of regime, has done fair bit on the IBC side of it. But whether the foreign investor will take that kind of risk or not on the lending side. Right. So that is one. Second is that the rupee dollar thing, that around 3 to 4% every year we are losing on that return, and whether my asset in which the money is going to get in is not going to generate money for next 3 to 4 years post the COD. So that becomes a challenge, whether I can bake that risk or not, because every money which comes in will look into the risk, that whether I'm pricing it appropriately or not. So those kind of things are seen, and people are reconciling to those facts. So we see that money is definitely sitting there, but they're looking for better projects and better environment to invest. So there is no like paucity of fund. It is the paucity of having the right projects. People are willing to definitely do the financing.
So you talked about the exchange rate depreciation, the kind of taking away some part of the return.
Correct.
Okay, if you are today able to raise money for a operational project at 7.25%, let's say, if 3 to 4% goes in the exchange rate variation, does it leave enough for the foreign investor to put that money into the project? And secondly, is there something that the government or the regulators can do to make sure this ambitious 111 lakh crore investment target is met, to be able to get the right amount of capital?
Right. So if you see on the renewable power side, most of the bigger platforms have raised dollar bonds. So of course,
they're generally for 3 to 5 years. They are not very long.
Right. So that has to be seen that they have been able to raise a lot of dollar bonds, but for short term, can we make it long term but dollar bonds? So people are looking into this risk, but are they comfortable in taking the long term risk or not?
Okay. So turning over to Sujoy, I think as a sponsor of some of the NBFCs, and also somebody who could be actively working with the government to get the new development financial institutions off the ground. Your views on how different it will be for them to succeed as compared to, say, IFCL has not delivered the expected outcomes that was expected out of it. The other two development institutions of the past have already disappeared into a bank, right? To some extent, but marked into a bank. Sorry, I should not say disappeared. So they're marked into a bank. So that is one aspect of how different it could be this time around to be able to succeed. There's no doubt that for successful infrastructure lending, at least at the construction stage, you need to have expertise. That's something that's my personal learning also as I was running electric finance holdings clearly. So that's my learning. So that expertise will come into these institutions. In terms of actual way to look at the projects and lending, will it be any different? The second thing I wanted to ask you is that some of the risks and exchange depreciation especially, do you think an institution of this type can step in to cover, to be able to attract the right level of capital from the market, international markets?
Shivaram, could you repeat the second question? I could not hear it very.
Yeah, but see, Mukesh was talking about 3 to 4% going away in exchange depreciation. Okay, how do we really, either the government or some governmental institutions or somebody else who can perhaps take that under risk of underwriting the 7-10 year exchange depreciation in a way so that the institutional investors from the international market can comfortably come to invest here?
Maybe I'll take the second question first. Also, just continuing on what Mukesh and Prasanna were saying. Look, I am a believer that infrastructure is really a local currency game, and the advantage of India is that India is a savings country. We save close to 20% of our GDP. I mean, this is $600 billion a year. The problem we have is that savings is not getting channeled into our sector, right? It's really, like you said, it's going into basically sovereign bonds, gold, and bank deposits, literally, right? So I think that, and if you really look at the institutional investment sector, institutional investor sector in India, it's large. It's about between EPFO, LIC, the other trusts. You're talking about $900 billion and one of the fastest growing saving systems in the world. So if we can channel even something like 5% of their assets into this sector, it is a substantial, it's a substantial inflow. And I think that's really where the holy grail is. It is not, at least on the debt side, I think there are limitations to getting foreign money into financing of local currency infrastructure. Not just in India, in any country, you would have that mismatch. And the other thing is the long term. And again, the long term nature of the sector fits really well with that, with those savings institutions. So, and I think, I don't know if you guys observed, but the government has done a couple of things in the last year to actually enable this also. So EPFO now can actually invest through funds, which it previously could not. And that was one of the gaps, in them going into alternative assets, which is that they don't yet have the expertise. They've developed the expertise, but they need to go in through fund managers till that happens. So I think it's a huge opportunity. I think, LIC similarly is starting to think beyond just buying bonds of NHAI, right? I mean, that's easy investing, right? That's not where you're going to get that additional return. The additional return comes actually by taking that little additional more risk. So I'm actually more inclined towards focusing on how to enable that domestic savings to come into a sector that is ideally suited for it. So that's what. On the development finance institutions, look, I mean, it's a complex answer, right? Because there were sectoral issues and there were specific issues, right? So I think the sectoral issues, like Prasanna was saying, I think the sectoral issues have evolved. And all of us are saying that, from a regulatory standpoint, it's much better. I think the movement from only greenfield development, I think that's a big difference now, which is that we now have built infrastructure that can be financed. Those days when, IDFC, ILFS started, there was no infrastructure to buy. It was all to be built, and that had certain risks. And they actually absorbed a lot of that risk. And they did it with not being able to always raise enough capital. And here, NAPFID is being funded with a substantial amount of capital. NIIF government has put in a substantial amount of capital, and we are building on that. So I think the evolution of the sector itself and the response of but at the same time, I think some government intervention in this area is required, because like we said, the domestic savings is not yet coming into the sector. But I think they're doing it in a much more stable, I would say, infrastructure sector environment, and also with much more equity.
I think we have lost Sujay to some extent, looks like. Okay. So we'll just give him another 20 seconds in case he's able to reach. Okay, so first let me get to you. The InvIT capital is, I would deem it as a bit of a hybrid capital, because the consolidated debt equity ratio undergoes a substantial change, which means that an SPV which would have been typically financed out of say 3 times debt is today getting financed by 2 times debt, right, of equity. So that's a big relief. So it will be a hybrid capital in my view. This appetite, do you see it continuing big time to fill the gap for both equity and partially debt?
So I think continuing from what Sujay mentioned, InvIT capital is one of the way that the domestic savings can be channelized to infrastructure assets, right? And one of the things which he was referring to, we'll just take a second on that, is no country's infrastructure can be built completely on foreign capital. And if it is done, you're waiting for a disaster to happen someday. So effectively, we need to be able to channelize domestic capital to domestic assets, whether it's debt or equity. And InvIT offers that avenue to direct access as well. So as a citizen, you can directly invest in an InvIT in a liquid manner. Yes, as an institution, insurance can do, pension can do, but as a citizen, you can directly do as well. So it gives an opportunity to channelize the domestic capital to domestic assets. And I think that is one link which InvITs offer to fulfill, because it has potential to channelize all the domestic capital, current savings and new savings, towards ownership of assets or Indian assets, which does dual advantage. One is it really activates the local capital market, which is a prerequisite for an efficient foreign investor. So local capital market gets an impetus. Second, away from the financing, it builds a connect with the country's infrastructure. And you think about if as an individual, you, as Sujay mentioned, you are owning a Delhi-Mumbai expressway in an indirect manner. While you pay a toll, but you also earn an income out of that. It builds a different kind of respect for country's infrastructure. And I think that is a transition for a developing country to a developed country, and especially for India, that if we are able to channelize domestic savings to domestic assets, besides the development of local capital market, we will connect with India's assets, which will build a much better harmonious environment for asset longevity and use and flexibility.
True, thanks. Sujay, getting back to you, sorry, we just wanted to use the time as you are dialing in back. Please come, I would like the response from you to be completed.
No, I think that was my laptop telling me that I'd spoken enough. So I think I made my point. And by the way, I completely agree with what Harsh is saying, which is, I think if we can develop that connect between Indian savings and Indian infrastructure, you will also see that the playing field will stabilize a lot more. I think, you know, regulators, courts, everybody will start looking at all this as an ecosystem rather than as investors just trying to take returns out. And I think that's crucial as well.
Okay, so given our the regulatory evolution is so mature, the capital market so mature, I think we will leave the foreign investors if he wants to exploit the arbitrage available by way of better returns and come in rather than providing any subsidy. That's what the view that's emerging. So moving to Mukesh, I think let me ask this question that there are enough number of investors wanting to invest in infrastructure, but do we know what could be the problem if someone invests without understanding the underlying ability to understand underwrite the risk that come along with it? So do you think an AIF could be a route for both equity as well as debt to channelize capital into the projects? And I would also request Prasanna to supplement if we can put in some thoughts on that.
Sure. So, like, if you see the nature of investments in infrastructure has changed, like people are looking for majority equity now. All the investors are looking to be owner of the assets versus they are the participants and let the local sponsor run the show. So they are happy that, okay, maybe there is a local sponsor, but majority equity needs to be with the equity investor, be it pension funds, be it a normal equity investor that we have seen through FPI route or AIF. So AIF, I think, would be more beneficial for the structured and for the debt kind of investments versus pure equity. Equity, let it come through the sovereigns, let it come through the pension fund, let it come through the normal FPI route. And AIF can garner a lot of structured investments in the infrastructure space. Maybe at the back of it, there might be a pension fund, there might be a sovereign fund behind it. But in the country, if it is a IOCC, which is an Indian owned and controlled AIF, they can do much better in terms of providing the flexibility, in terms of the tenor, in terms of the structures that are being proposed. And if you see the kind of sponsors are there, means like go back in like 2010 and all, people were EPC players and they just wanted to be on the like BOT side. So they started to garner asset, they could not chew it. And that led to a lot of distress being created in the system. But today's sponsors are very clean, clear. They have done their IPO. They are sitting there, okay, we will take equity once the money is available, then only we will go ahead and buy some projects. So they're not taking much leverage on their balance sheets also. So I think the nature of investing both for investor as well as for the debt provider has changed. And I think education is not a problem that whether they will do a mistake by not knowing the investment. Everybody like sitting in Canada, sitting in US understands India very well. So I think that piece is totally gone and taken care of.
Okay. It's more aggregating and putting making it flow into the right.
Like we have two big asset owners on this panel already.
Okay, given the time constraint, one last question, which again perhaps can go to each one of you. The stressed assets in this sector is a very large opportunity. Okay? Also a bit worrisome for some of the institutions that are owning those stressed assets. So one aspect is that, do you see a quick resolution being possible outside of the NCLT route or the IBC route? And secondly is that some of the NPAs have also arisen because of the this immature regulation as it existed those days. Do you think that there is a need for some kind of governmental intervention to clean up some of those NPAs in any manner that they can potentially do that? Maybe both Sujaya or Harsh and Mukesh can respond on that quickly. Keep it short because we are already just about a minute more than the time.
Yeah, I can start, and we've actually acquired a couple of these stressed assets, but it's basically becomes a matter of pricing, right? And the thing is this, that if the sellers are able to come to a pricing, then there are for these current environment. But your question about using the NCLT route or not, sometimes you need to go through the NCLT route in order to close out the liabilities,
Of the past.
of the previous owner. But sometimes if you're able to, because, in these kinds of situations, you can't get reps warranties, and even if you get them, they really don't mean much. So it depends, but I think the key thing becomes pricing, because I think the risk-taking, capital is there, but in many cases, the holders, either the lenders or the owners of these assets are just not able to get, what should I say, make peace with the kind of the pricing that is required to get these assets transacted. I mean, that would be my short answer.
So, like on the distress side, I've been working quite deeply into that. So what I understand is that IBC has done fair bit already. That it's like around 7,000 cases were referred, 300 has been solved. But what is not solvable is just lingering over there. Either they're getting into liquidation or there are no bidders for that. So banks who are the creditors over there, they need to understand that IBC is not the only route. They need to understand that they should take a call early on before putting the company in IBC, making it more deteriorated. Employees will leave, companies, plants will shut down. To restart the plant, more capital is required. So all those challenges will come in once the company gets into IBC. Of course, we have a SR Steel or Bhushan Steel kind of good examples, but I think the bad examples are much, much more in proportion to what we have seen. So I think NARC is a good thing. What government is trying to do is that they're aggregating the asset at one place where somebody can go and bid. Because today, when an ARC tries to buy from these banks, 2 banks out of 8 are willing to sell, and maybe 6 are not selling. So then the resolution cannot happen in the company. You are one more lender sitting over there. So all these evolutions are happening. People are talking about pre-packs with the current promoter. If that happens, that has been a success in developed countries. And you need to believe in the promoter at some point in time. So investor is taking the risk. Enable the regulation. Investor will do their diligence and take the risk on the promoter if they want to continue in a pre-pack kind of situation with the current promoter. So I think multiple ways are being discussed, and things will get solved. As we move ahead, IBC is not the only option.
Great. Anything from Harsh as a potential?
Just a continuation, I think a very small point, more softer than really specific change. I think boards and management of financial institutions needs to be more empowered and held accountable for taking these decisions, because they miss out in the whole mathematics of holding period of 6 months is going to deteriorate value by much faster pace than negotiating a 5% higher or lower haircut. So I think that part of the piece of the puzzle gets missed, sometimes because of genuine concerns, sometimes because of just worry of getting checked and getting crucified for a decision. So it's not an easy ask, but how do you empower the management teams and boards of these financial institutions to take timely call is the softer aspect.
Definitely.
Yes, sir. We need to find the answer for that. All right. With that, I think we've just about run out. We can continue to discuss that because so many interesting aspects out of all that points that each one of you have made. Thank you so much. Let's see if there are any audience questions. So maybe spend another 10 minutes maximum if you all have that time. Deepak, any audience questions?
Hi, this is Arijit from CI. So we have not yet received any, questions from the audience. Probably the session was very clear, and So thank you everyone for joining us.
Thanks, Vijay. Thanks, Harsh. Thanks, Prasanna, and thanks. Made my life much easier and smooth. And I also got to learn a few more points from whatever I've learned so far. Thank you so much.
Sure.
Thank you, and great to see you all. Thanks.
Yeah, thanks. Yeah.